Welcome back to Financial Independence 101. This is Mike, and this is hopefully your place to go to get excited, motivated to make money, save money, invest money, become financially independent. But it's been a week, it's been 2 weeks since I've uploaded. I usually upload at least once a week. Last week was a crazy week. I've got a lot to talk about, got an action-packed episode for you. But we're gonna talk about several things. First, we're gonna talk about bubbles and what the bubbles are, all these bubbles easing that they're doing. This is the money they're printing and injecting into the system. This is the interest rate cut that we just got, another half point yesterday. This is more interest rate cuts, more quantitative easing, more stimulus popping, the bubble popping that's gonna go on. We're gonna talk about how overvalued the stock market is. Still, to this day, I actually have proof based on something that nobody talks about since forever, fundamentals. Of course, lastly, I'm gonna give you options. Now, I'm not gonna give you investment advice. I'm gonna say, if you do this now, this is what could happen for you. So just give you some ideas coming up. Last week, we saw a downturn in the stock market. It was crazy, but not crazy enough. I think what we have coming is going to be even worse. And a lot of people want to talk about, well, I have good stocks. My stocks are solid. I own nothing but the best high quality companies that, by the way, they shouldn't go down. I'm going to tell you why every stock will go down in a week like last week. It's not that the good stocks all of a sudden are bad. It's because the vast majority of investors invest through ETFs or exchange traded funds, or they're buying baskets of stocks at a time and not individual stocks, which actually helps give you diversification, but that diversification can hurt you. So the first reason why the market, when it goes down, good will get tossed out with the bad is because of the ETFs and the diversification. Because if all of the market is going down and people are selling their position, which is just an ETF, which is just a basket of stocks, and they decide to sell, they're selling everything. They're selling the good with the bad, and that's going to cause the good stocks to go down. I witnessed this in 99 and 08, but I think nowadays ETFs are far more popular. The stock market is overvalued. I feel the stock market has been overvalued since 2016. I don't think that most people are trading on fundamentals. I have a lot of reasons why most people aren't trading on fundamentals. I can almost guarantee you that. So all of these bubbles are arising. And as these bubbles, here's a different color one. All these bubbles arise. The problem is they're gonna pop. And when they pop, we're gonna see, well, stuff like last week, but there won't be an end to it. And that's the scary part. But let's talk about valuations right now in an overvalued stock market. I want to talk very specifically about a few stocks. So when you look at a handful of stocks in the overvalued department, when you see, okay, Apple, is Apple overvalued? Well, you look at something called price earnings ratio. Well, what is the price of the stock versus how much money that they make? The whole reason you buy stocks is hoping that these companies, you're buying companies that are gonna make a profit. And they're gonna throw the good stocks out with the bad, because I'm gonna talk about good and bad right now. Looking into this, Apple. Apple obviously is a company that is really strong. By the way, they can charge astronomical amounts of money for their products, and people pay them. People buy their products even though their old one is perfectly fine. Let's go spend another $1,000 on an iPhone every 6 months. I don't get it, because I still use the same phone from 4 years ago and it works fine for me. But Apple has a price earning ratio of $22.85. Amazon, everyone can say Amazon is extremely important because they put out so much product for a good price. They're very relevant. But they have an $82, almost $83 price earnings ratio, meaning that the higher the price earnings ratio is, that the more overvalued it is. Look at Walmart. You have to know Walmart's very profitable. Walmart is everywhere. $22.63. That's normal, I guess you could say. I'm actually surprised Apple's as low as it is, to tell you the truth. Microsoft, $28.71. Juniper Networks is a company that near and dear to my heart because I lost money in it back in the 90s. $22.91. It was $240 when I lost money in it, by the way. And then Netflix. Netflix, everyone knows what Netflix is, right? Most people use Netflix every day. That is priced at $89.29. Is that overpriced? Well, let's look at Uber, Lyft, and Tesla. What is their price earnings ratio? Let me look that up real quick. It's listed as not available because there is no price to earnings ratio if they don't make a profit. So the next thing I want to talk about is new investors. It appears that all of my friends and family and everybody I talk to about investing, well, they weren't investing in 1999, they weren't investing in 2008, and so they really know nothing but an up market. So these investors that didn't participate heavily in 2008 and in 1999 are just used to waking up in the morning and having the ability to throw darts at a dartboard with a bunch of stocks on it and hit that dartboard and you pick a winner. And that's not what's going on these days. I've got to tell you that these people don't understand that the stock market can go down. And last week is an eye-opener to a lot of these people, and it's a little bit scary. Well, let's say extremely scary to somebody who's in it and hasn't lived through it before. Now, I lived through it in the 90s. I made about $12,000 from 1994 to 1999 to a high school kid. That's a lot of money. But then you think about it, I lost $30,000 in 1999. That was scary. That was devastating. In fact, I feel like I gave back all of my money that I earned working and everything that year just because of my investment losses. But I learned something from that, and I think it's really valuable when you learn something. When you have the worst of times like that, you can learn from it. But so let's get into all of these bubbles that might be popping soon. What is a bubble? How would you define a bubble? Well, I'm using little balloons. I think they're my kids' they're the water balloons actually, but they hold air. Water balloons hold air. So gonna work really good for this demonstration. Now, there may be a loud pop. I'll warn you before that so you can mute your screen if you have like a heart condition or something. But there are bubbles all over, whether it's the stock market, whether it's the auto sector, whether it's the housing sector, whether it is the banking sector, actually. There are bubbles all through the economy, and the government knows this. The Federal Reserve knows this. Trump knows this. And what they're doing is effectively putting a piece of tape on this bubble here. This is the easing that they're doing. This is the money they're printing and injecting into the system. This is the interest rate cut that we just got, another half point yesterday. This is more interest rate cuts, more quantitative easing, more stimulus, all this stuff they're putting on this bubble. But at the end of the day, if we have a catalyst, say a global pandemic, mute your screen if you have a heart condition. This is gonna pop. It's still gonna pop. No matter what they do, the bubble is still gonna pop. And once one bubble pops, it could cause the other ones to pop too. And that's really the best example I can have. What is the definition of a bubble? Unsustainable. It's grown to a level that's unsustainable. The stock market is unsustainable at Dow 30,000. That's why it corrected. Let's get into that other term, correction. A correction is when an overvalued asset goes down to, get this, a more correct level. Have you ever thought about the term correction? You hear it all the time on CNBC, you hear it all the time, all these people talking. But a correction, they're telling you it's overvalued. It's not at the right level now. It is closer to a correct level. What is the correct level? We won't know till we see a bottom. So what are your options right now if you're an investor? Mike, you said a lot of stuff, but what's helpful? First thing you could do, you can make the decision to sell it all. Now, I'm not telling you to do that, by the way. Mike told me to sell it all and then it went up. I'm not telling you to do that. But I'm going to tell you, if you choose that option to sell your entire portfolio of stocks, then there's a couple of things you need to consider. The first thing you need to consider is when the downturn comes, you're not going to lose however far it goes down. 50%, 70%, you won't lose that. More than likely. More than likely. I can't guarantee anything. Nobody can guarantee anything. But the other thing is, where are you going to put that money now? See, with these interest rate cuts, they have really changed the landscape of fixed income investing. And I look at that closer than anything. I look at fixed income investing far closer than even the stock market, because the stock market, okay. Fixed income investing is where it's at for me. And I've noticed that last year I was buying up 3.3, 3.1, 3.15% yield investments. This year, the best I can find on a 10-year CD is 1.4 because it's non-callable. Never buy a callable CD. That's just, they're going to go down to 1% or 0.5%, and then they'll give you your money back and then write a new CD. Then you're sitting with nothing. You always want non-callable when you buy those things. But I missed out at the 3.65. I thought we were going to continue raising interest rates. We're in the greatest economic time ever. We weren't, and we still aren't. This isn't the greatest economic time. This is just being held off. The bubbles we're waiting for the bubbles to pop, and they're making the bubbles bigger, so when they pop, it's going to pop a lot harder and a lot louder. Scenario number 2, you could sell half your position. Now, I've talked to people about this, and I was saying if you sold half your position, you profit take. Look at, if you quadrupled your money, let's say you had $100,000 a decade ago, and that made you're up to $400,000, so you made $300,000. If you take off with $200,000, you profit take on that. Obviously, you, depending on if you're in your IRA 401k or in a standard account, you have to think about all that tax liability wise. You may be liable on taxes for all of that, but if you've held it longer than a year, which you probably have, then it's a different rate than just standard earnings. But think about all those things. If you do sell half of your income or half of your portfolio, then you might feel better, and then you could let it ride with the other half. You can let that 200,000 turn into 30, but you still know you have 200,000. That's something you could do. But I'm going to tell you, I already told you, but option 3 is what I already did, and I did it all last year. I got out of the market in 16. I was making a really low amount of money. Once the rates went up to, I was wanting 5. I was going to settle for 4, but I had to settle for 3.3 to 3.15 and all that range. But now I can sit back and make 20+ thousand a year on my money while it appreciates. What, 50,000 a year, I guess, is what it's looking like. But I can do that, and that's what I did. It's too late to do that, but if you do choose to go that route, you understand you're only going to be getting 1.4% at the best. Maybe you find a CD or something that is FDIC insured. Make sure it's insured. I'm fairly confident that they're going to pay out if government doesn't pay out FDIC. We may not ever see a recovery in my lifetime if FDIC doesn't pay out. That would be the end of the banking system as we know it. Hope I was able to help you out just a little bit, shine a little bit more light on the situation and what's going on. There's going to be a whole lot more to talk about, so I guess I need to make a whole lot more videos. Like, subscribe, keep coming back to get motivated and excited to make money, save money, invest money, and become financially independent, just like me.